Welcome back. The Federal Reserve set to hold its two-day FOMC meeting in 2 weeks' time. Chairman Jay Powell is widely expected to raise interest rates for a third time this year. With unemployment numbers at historic lows and the GDP gaining strength, the odds of a September rate hike weigh in at over 95%. Joining me right now to talk about the backdrop on the economy right now is the Federal Reserve Bank of Dallas President and CEO Robert Kaplan. We should note that the Dallas Fed is not a voting member this year. And Robert Kaplan, it is good to see you this weekend. Thanks so much for joining us.
Good to see you, Maria.
So when you look at where we stand right now, we just saw 2 straight quarters of 4% plus economic growth. We also had data just this past week. Retail sales was weaker than expected. Inflation was basically, it looked like a non-event. What's your take in terms of what the Fed should be doing with regard to interest rate increases? Have things changed in any way for you?
They haven't changed. I still think we'll grow at 3% in 2018. GDP will grow at 3%. We still think the unemployment rate will continue to move lower. And we do think we are reaching our 2% inflation target. And monthly data can be volatile, but we think we're moving toward or already reaching our 2% inflation target. And the August monthly retail sales number would probably be one I wouldn't overreact to, in that July was a very strong number, and these monthly numbers tend to be a little bit noisy. Everything I see out there tells me the consumer's in good shape. They've deleveraged, number one, and number two, the job market is strong. So I'd be confident about the strength of the consumer right now.
Okay, so the consumer is strengthening. You're also seeing a pretty strong showing from the business community, right? I know you're out talking with business managers all the time.
Yeah.
Tell us what you're hearing in that regard.
So there's been strengthening in CapEx. A big chunk of it relates to the energy sector. So it may not be as strong as people might have hoped. And I also see a number of the CEOs I talk to are taking CapEx they would have spent a year or two from now and moving it to this year because of tax incentives. But even with that, business spending is strong. And so we've believed all year that 2018 would be a very strong year. And a big reason for that is the strong consumer, solid business spending. And in addition, maybe most importantly, we've got a very sizable fiscal stimulus, not just the tax legislation, but also the budget deal. And that fiscal stimulus is at its height in 2018.
Yeah, you make a lot of great points. I want to take you back, Robert, to a conversation you and I had about a year ago. And when we spoke, you said to me, look, Maria, I think we're going to see good growth in 2018, 3% or so, which you just reiterated a moment ago. But things will slow down the years following. You said we could go all the way down to under 2%, 1.9% growth looking into 2020, the end of 2020. Why? Because this narrative is gaining steam. Other people have jumped on that bandwagon after you said it, expecting growth to slow down in the next 2 years. I recognize the fiscal stimulus might not be at the height where it is right now, but what else is factoring into your expectations that things will slow down in the coming years?
So, as you said, fiscal stimulus is at its height now. The effect will fade somewhat in 19. It will fade further in 20. And at the same time the fiscal stimulus is fading, we've got a couple of very strong drivers that we have to pay attention to. The population in the United States is aging. This is going on in most Western countries, and it means workforce growth is slowing. GDP is made up of growth in the workforce and growth in productivity, and workforce growth is slowing. Then the second issue is productivity growth has been sluggish. And it's not that every industry isn't highly productive or more productive. It's that there are 46 million workers in this country that have a high school education or less. And what happens because of automation, to a great extent, and to some extent globalization, but pretty much more importantly due to technology, they're finding their jobs increasingly restructured or eliminated. And unless they get retrained, they'll find another job, but it'll likely be in a job that is less productive than the one they left and makes less money. They'll make less money. And so I think you've heard me say we need to strengthen education and skills training in this country to deal with this productivity issue. And then I'll mention a third issue, which I'm concerned about. This fiscal stimulus is a tailwind right now. We're increasing our leverage, but it's stimulating economic growth. The concern is in the out years from now, if we choose to moderate that leverage, the government leverage, entitlements, as well as government debt held by the public, that tailwind could become somewhat of a headwind. And so we just have to take all those things into account.